Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about if we can pay off the mortgage under 5 years, right? And when we talk about pay off the mortgage, obviously, number one, we have to have income to qualify for it. But what if we're in a position where we don't have that much left over because we have a lot of debt? Now, I'm going to tell you a little bit about myself. 5 years is way too long for me. So I don't know if you ever heard of those velocity banking channels where they advertise, oh, you can pay off your mortgage in 7 to 11 years. I'm like, what a joke. And the reason I say this is because I paid mine off under 3. Now, I'm not saying that those results are typical, but what I'm saying is that, yeah, it is possible, but you obviously need the income and cash flow to do that, right? So I'm not overhyping or overpromising anything. And in fact, when it comes to paying off the mortgage, um, I feel like it's the least important debt we should pay off because it sucks up the least amount of cash flow in comparison to all of our other debts. So let's get into it. So what is velocity banking? All it is a debt payoff strategy using a line of credit as our main operating account. And in today's video, we're going to focus how long does it take to pay off this mortgage right here. So how long? But we're going to assume uh, after we've paid off these other debts, we're going to assume that the mortgage is going to be less, and we're going to separate the time frame in which we pay off the mortgage compared to all the other debts, just because I want to fit the thumbnail of this video. So that's going to be the theme of today. How long is it going to be take to pay this off? But we have other debts too. We got one, two, three, four, five credit cards. We got an auto loan. We got a savings account, and so we got to have some savings, right? $1,000 according to Dave Ramsey. And so, yeah, let's get to it. So, only two things that we need for velocity banking. Actually, let me erase this. Number one is a budget, and then number two is a line of credit as your main operating account, right? And so, the budget is essentially the debt attack plan. You have your income, you have your expenses, and then you have your leftover savings, right? And where it comes to velocity banking, we're almost going to do the same thing, right? Income, expenses, but what's really important is that the savings is essentially going to go to zero, right? We're not going to have any savings. And if you take a look at my savings or checking account balances statements after every single month, it's zero or near zero, right? I've never had it gone over like $200. That would be insane for me to have a balance that's not close to zero, because we're gonna dump all of our income into our line of credit while we're paying off debt. And once our debt is paid off, then that might be okay to have savings. Okay. And then we're going to assume that we have access to a line of credit. Now, I know that for most people, when they see this $100,000 line of credit, that's impossible, right? Like, how do you do that? And I want to pull out one of those Master Yoda moments where it's like only impossible in your mind, right? And then here's a 15 grand line of credit. Here's a $280,000 line of credit. Again, what's a line of credit? It's a financial tool where you could borrow money, pay it back, and then use it over and over again. That's all a line of credit is. And some people have never heard of it because they're familiar with credit cards. But guess what? Credit cards are a form of line of credit, right? That's what a credit card is. It's a form of a line of credit, but it's not as flexible compared to the home equity or the personal lines of credit. And we're going to assume for today's video, we're going to have access to $100,000 um, home equity line of credit, right? Home equity line of credit. All that means is you gave your home equity as collateral to the bank, and then they're gonna give you a line of credit, kind of like a credit card, up to $100,000 in this example, right? So how do we increase this cash flow on day one without making more money? Let's just do a debt transfer, and the easiest debt that we can transfer is these credit cards, okay? And so if we add this up, this is about $85,000 of credit card debt. And then I just put 85,000 right here, right? 85,000, and then guess what happens? Oh my goodness, these all go to zero, right? So now this is $743, and then we went from $743 of savings into zero, but we increased our cash flow, which is the amount that the debt gets reduced after every single month, right? So the actual velocity banking strategy is into your line of credit. You're going to put that entire $8,000 of pay into that line of credit, and then whenever you need to take out expenses, right? whether it's your mortgage, loans, possibly your credit card debt, um, or monthly credit card bill, you're going to take it out of the line of credit. So expenses out of line of credit, and this is how much. Whoopsie, I can't even type today. So this is how much, the $3,500 is how much our debt is going to be reduced by, right? So let's go ahead and do this and do the calculations. So this is going to be I2 plus 1, and then this one is going to be G2 plus H2 minus. So basically, in order to get the next month's balance, we got to take the previous month's balance and interest minus our cash flow, which is 3570.66, right? And then what we're going to do is we're going to take the average of these two numbers, right? Or it's an estimation of the average daily balance, which is how interest is calculated for a line of credit, multiply it by the 9% interest rate, 0.09, and then you divide by 12, right? So let's go ahead and do that. And then after every single month, right, we can see that the balance is going to go down by this 3,500 plus the interest cost of the line of credit, and then we're going to go ahead and do that, and we see that after about 27 months, right, 27 months, this is gone. Wablam, right? Wablam. All right, so let me go ahead and highlight this right. Actually, not the wrong one. Highlight this right here when all those credit cards got paid off. So 27 months, and so 27 months, and then how much was that? Was that 85K? 85K of credit card debt. So, this could be a huge psychological burden for most people, but again, we paid it off pretty quickly. What's 27 months? So 27 divided by 12. That's about a little bit more than 2 years, but not bad. 85,000. In some markets, that's the cost of a house. So if you're in a cheap area. So now we got to figure out what the current balance of the auto loan and the mortgage is, and luckily we have this loan calculator to help us figure out what the balance is. We just put the original balance, the interest rate, and the loan term. It spits out a payment amount. We got functions here in Microsoft Excel. They call them like TMV, money value calculation functions, I think. And all we got to do is spit out a number of how many months have passed. So we see that 27 months have passed, and that's the current balance of the auto loan and then the current balance of the mortgage. And you can see right here, we already paid about $2,500 of interest, right? But that's not that bad. Now, what we want to do is recover the cash flow. So if you take a look here, there's this thing called the cash flow index. The lower the number, that's the debt that we want to pay off into the line of credit. So anything under 50 is a good candidate for that, and above 100 is not a good candidate, because take a look at this. If I pay off this $240,000 debt, I get $1,500 back, whereas if I pay off this $12,000 debt, I get $430 back. So I'm going to focus on this one first because I get more bang for my buck than focusing on this one, right? So this is why I say, well, the mortgage is almost the least important debt that we pay off, but it makes a good clickbait thumbnail. So let's go ahead and go out and pay off this auto loan, right? And so I'm going to copy and paste this right here, and then do this, and then what we're going to do is add that 12 grand plus 12975.77 into the line of credit. And guess what happens? Simply by adding this, all the rest of the auto debt into the line of credit, we get this $430 back in cash flow, and now we're at $4,001 of cash flow, right? $4,001, okay? So let me just kind of go in here, and then they're going to do this, and then do 4001.12 and replace that cash flow with our new cash flow or updated cash flow. And now we see that, whoa, in month 30, it's paid off. So it only took 3 more months. Is that right? Man, that's unbelievable. 3 more months to pay that sucker off. Okay, so now at 30 months, we're going to be 85 plus 22. So equals 85 plus 22. It's 107K, right? 107K. Okay, so now it's time to attack the mortgage, right? Now let's figure out the balance of that mortgage after 30 months, right? So it's about $241,000. And look at all this interest that we paid, 36 grand. And it's like not even been 3 years, right? And look at how little of the principal got chipped off, about 9 grand. So now it's time to attack the mortgage because even though this is an efficient loan, quote efficient, just remember that efficient loans make you pay a lot more interest than inefficient loans. So cash flow versus interest is always the trade-off, right? That's why you get a mortgage, because you want to be able to get into a home for a little monthly payment, but for that little monthly payment, you're going to pay a ton of interest to the bank. So after 30 years, we'll do 360, 30 years. Look at how much interest that the bank gets for that $250,000 loan. Or technically not the bank, because usually they sell it off to someone else right after you get the mortgage, but you get my point. All right, so now we're at 30 months and we just got to attack the mortgage. And there's two ways that we can attack it. Number one is just simply put in the extra $4,000 in as an extra payment to the mortgage. Now, let me tell you about this. Most people never do that because that's the default option, right? Why do they never do that? And why don't they pay off their mortgage in 5 to 7 years instead of refi? Because a loan is a one-way street. When we put that extra money directly into the loan, we can't ever use it back. That's the biggest fear. But when we put in the line of credit, yes, we can overpay it and have easy access to the money, right? And I probably need to go over the extra payments versus doing the what we call the chunking or moving into a line of credit. Now, one thing we definitely don't want to do is replace the mortgage with the line of credit. We don't want to replace this $250,000 loan with the 9% line of credit because we don't get enough cash flow to offset this 6% mortgage. And I've done this calculation many times in other videos, but we might do this another video because people love seeing this for some reason. And so again, let's just move $10,000 of this into that line of credit and see how quickly it pays off. Because remember, let's take a look here. We have been paying for 30 months and we still did not even chip away $10,000. We paid 30 months, right? So let's go ahead and do this and just move $10,000 into that line of credit right here. So plus 10,000, and then just live our life. And wablam, it took us 1, 2, 3, about 3 months to do something that we couldn't even do in 30 months, right? So you see how easy that was. But the mortgage is actually the least important part of doing all of this because this is the loan that we attack very last, not first, right? In fact, I did a YouTube poll where I asked like, this question, like, do you attack the mortgage first or last in velocity banking? And I think 30% of the people answered first. So we got some review to do, people. Okay. Now, luckily, I have this velocity banking calculator that I'm going to pull out because the calculation payoff is a little bit complicated because when you do this, I'm sorry, I'm in the wrong sheet. So when you're right here, you're still making the monthly payment to the mortgage. So some of the principal is being taken away by the monthly payment, as well as moving it to a line of credit, right? So just be aware of that. And so the calculation is a little bit complicated, but luckily I have this velocity banking calculator um, at my disposal, right? And let me open it up right now. And then you can see it right, where is it? Okay, right here. And this is a calculator provided by Renatus, which is where originally I learned velocity banking from in 2017. And this calculator was actually available to me in 2017 too, because the instructor Randall, he's a whiz with Excel, and I can't do any of this. I'm not as smart as him, right? But let's go ahead and put in the deets or the details, and I'm just gonna. Oh, and that's the cool thing here. And full disclosure, and I always like to say this because I don't want anybody to think I have hidden agendas, but I actually have an agenda. I actually make commission off of selling these products. And some people get so bothered by that, like, oh my goodness, you make money off of this? Listen, you go to any business and act surprised that they make money off of you, even a bank, right? Like, people are so, I don't want to say stupid, but like, I can't think of any other word. And then they're gonna get offended, but they want to be tricked too. That's the worst part. Like they want to say, hey, I'm getting a 6% mortgage, and then in the back end, you're actually paying what 120% of the loan. Right? So, all right. So let me go ahead and put in this information right here. And so let me put in the income, which is about $8,000. So we got good income, better than the average bear. And then the expenses is 2,500. And then what's the payment amount of the loan? It is 1498.88. 1498.88. And then what is the interest rate? Right? The interest rate is 6%. 6%. And then what's the balance? The $250,000 balance. And then what is the current balance or the original balance and the current balance? So 241,966.27, 241,966.27. And again, I'm looking at the other screen while doing this, and let's take a look. So, a lot of people focus way too much on the chunk amount, but just as a general rule of thumb, I say what's really important is the number between here and here, not the chunk amount. The chunk amount is just there, kind of like an intermediary to allow you to use your cash flow to pay it off rather than pay it directly. But just be aware that the more you chunk, the more you actually pay in interest. So ideally, it would just be like a low number, kind of like similar to your paycheck. Let's do 10,000. Well, blam, 4.2 years. All right. So 4.2 years, we paid off that mortgage. Wow, that was so simple. Let me do a $20,000 chunk, 20,000. See if that changes anything. I'd say this will increase a little bit. Let's go ahead and do that. Same year, same what's it called? A little bit more interest, so let's do 10,000. All right. So, let's go ahead and copy this. So this is 4.2 years, right? 4.2 years. And let me go to the other spreadsheet. And um, where are we? All right. So now it took us 4.2 years to pay this off, right? When we just focus on paying the mortgage, right? Now, technically, um, we have to add 30 years or 30 months to 4.2. So 30 plus 4.2, or 30 divided by 12 plus 4.2, right? So 6.7 years to pay off the entire debt, right? So all all debt paid off in 6.7 years. But when we focused on the mortgage, it was less than 5. Pretty easy, right? And so now this will go to 0. And then, well, blam, we got $5,500 now into our savings account because all of our debt is paid off. So 5500, and then the next month is, I think it's like 1100, or what's 5,000? Is it 1100? And then so on and so forth. And then after every single month, now you have two emergency funds. You have your savings, and then you have your line of credit. And then at this point, I probably use the line of credit as like a secondary savings, because if we pull out money from the line of credit, we're always charged interest. Now, exception to this is credit cards. So, I always like using credit cards even if I have savings, because it's like a 1 month free loan. You know what I mean? As long as you pay the statement balance in full. So, and you get points and benefits and all that. So, love using credit cards to pay my general expenses. Even if I'm debt free, I'm still going to use them, but I'm still going to have the savings here and then pay off my credit card bills with my savings. So, I'm going to have rich people problems. So, this is kind of like my proposal to you is you want to have rich people problems. And this is when you worry about, like, should I invest my money? Who do I do it with? Or what should I do now? And here's the thing: this whole Velocity banking channel is essentially just a giant sales funnel for my Renatus independent, what's it called? Work business to sell educational products as an independent contracted marketer, right? And so if you're interested in learning that, go ahead and click the Google form link below. But most people, because they're only thinking about paying off debt and they don't see the next step, are probably not gonna submit the form, and I'm okay with that. I'm like a bank, right? I'm gonna only work with a very few people, and I don't know if you ever heard the statistic that banks don't work with 90% of the population, especially when it comes to mortgages, right? So that's who I want to be. That's who I want to present myself as. So, some people might like beg me to work with them. I was like, what's in it for me? And they don't think of that win-win. And, if you actually make everything like a charity, you're kind of going to be like Whole Foods in San Francisco. Look up Whole Foods in San Francisco and how long it took for them to get out of that prime real estate space after, and I'm going to give you a hint, it's after 1 year. All right, so you don't want to do that. All right, well, that's it for today, everybody. So you can see that when we focused on paying off the mortgage, it was less than 5 years, right? But in total, it took us 6.7 years to pay off that debt, right? Now, technically, you could say that, oh, it took the mortgage 6.7 years to pay off, but again, we're just talking about when we actually focus on paying off the debt, how long did it take us to pay off, which is under 5 years, which is way too long for me because, as we all know, it took me under 3 to pay it off. So if I have another mortgage that I'm paying off and it takes me more than 3, I'm going to be totally disappointed. Okay? Now, again, I know everybody has their own standards because it takes more than 30 years for a mortgage to be paid off because of refis and all that. But oh, excuse me, I'm burping, and these days when I get excited, I tend to burp. Um, but back to my point is that now, in my standards, anything under less than three is a huge disappointment in my world. Okay, well, that's it for today, everybody. Have a great day. Have a happy Saturday. And what else could I say? See you on the next video.